So today I'm going to talk about the short and long-term effects of job loss on employment and pension claiming at older ages. And this is joined with Jay Song from the Social Security Administration. And the views expressed here are, of course, not uh, those of the Social Security Administration. And I should say we've been working on this for some time with fits and starts because of data access. But I want to clarify one thing. The results from this paper are, very relevant for thinking about the possible long-term effect of the COVID-19 crisis. Since this is one of the very few papers looking at long-term outcomes in terms of labor supply and pension claimings of a job loss. But of course, since we cannot look into the future, we're going to go back and look at the effect of past job displacements over the very long term. And that I think will be quite interesting. So there has, of course, been a lot of research on both the short and long term effects of job displacement. But it's fair to say that when it comes to Social Security, the focus has been on the impacts on job losers taking up disability insurance, less so on the incidence of claiming Social Security, which I'll sometimes call old age survivor insurance, or use that acronym OASI, but that's just public pension benefits in the United States. And there have been some papers on the short run effect of a job loss on the incidence of retirement and claiming pension benefits. And the concern here is very similar as in Olga's paper, that workers treat public pensions as sort of a short-term insurance mechanism, and as a result, they may permanently leave the labor force. And we have some evidence in the United States and other countries that older workers who get laid off, are more likely to exit the labor force permanently. And that's certainly very important and interesting in the time of COVID-19. But in principle, the Social Security Administration in the United States and in other countries can see, the drain from the labor market of these older job losers in real time. And then the question is, well, is that the only impact of COVID-19 or job loss during COVID-19 on the pension system? And here we're going to take sort of a different perspective. We're going to think about, well, what could the longer run impacts of job loss be? And one interesting piece is, of course, that we know that job loss can lead to a permanent reduction in earnings, and hence to a reduction in lifetime wealth. And so you would expect that there's a negative wealth effect on labor supply, meaning if wealth goes down, just to be clear, we expect that labor supply over the life course goes up, right? And one important margin for those, especially who already work full-time, full year, right? One important margin of adjustments of lifetime labor supply is, of course, extending the working lives. Right? In addition, in the United States, workers have an incentive to replace 0 years in which they had zero or low earnings with years in which they had higher earnings down the line, because pension benefits are calculated using the 35 years of highest earnings. So if somebody had a few years of low earnings because of a job loss, they have a further incentive to work longer to replace those low earning year, right? More generally, right, increasing labor supply is a potential margin to which workers can just make up some of the lost income after a job loss. And I'll show you that right away. And looking at this question of longer term effects of job loss during middle age on retirement choices and on claiming public pension benefits and the amount of benefits is also interesting, because we care about additional evidence of the role of financial decision making in choosing when to retire, and we also care about the long-term effects of these larger recessions or crises as the COVID-19 crisis on the Social Security system. So what we're going to do, we're going to use some pretty amazing data from the Social Security Administration, and of course, this is very special for the United States and other countries, including Chile and certainly Germany and other places. We have access to this type of data more regularly, but this is very hard data to access in the United States. We have generated firm level employment counts from the worker file containing all earnings of employees in the United States, and then drawn a 1% sample of workers. And so we get a matched worker firm panel spanning the years from 1974 onwards. And we stop here in 2007, which is sufficient for the purposes of this paper. And what's particularly interesting here is that we can combine this worker firm panel with information on pension benefit claiming and benefit amounts, right? So while you can sometimes get these worker firm earnings panels elsewhere in the United States, it's very rare then to an additional get information on administrative data on pension claimings. And so what we're going to do, I'm going to start with the benchmark and estimate the effect of a job loss on short-term earnings, employment, and then I'm going to estimate the long-run effect. Now, to estimate the long-run effect, I of course have to go back in time. So today I'll focus on a very large recession that occurred in the early 1980s, because for those workers, I can look, over 20 years into the future to see how their labor supply evolves. And so I can see a job loss occurring in middle age and see what then happens when they reach pension age. It is, of course, a different cohort of workers. And, we have to be very careful to do any extrapolation to today's labor market. And, after showing you the long run effect on labor supply using earnings as a measure, I'll show you the long run effects on benefit claiming and on Social Security benefit amounts. So, I'm going to describe in 30 seconds what would be the majority of the paper, namely explaining you exactly how the sausage is made here. And what we do, we look at workers who lose their job when their employer had a sudden and large and lasting restructuring of employment, which we'll call a mass layoff. And the way we define a mass layoff is pretty standard. And to look at sort of these large percentage drops in employment, we can only look at firms who initially had 50 workers. And the benchmark year here is the year before the recessions in the early 1980s is 1979. And we look at, for this paper, male workers who were on average in their early 40s at job displacement and who had 6 years of job tenure. So these were stable workers at above average employers that get suddenly hit by a shock. And then we look at their short and long run outcomes. And contrary to other papers, we don't have to restrict any employment or earnings after job displacement because we have everybody in the United States. And so zero earnings as an employee means something. And in addition, we only look at workers claiming on their own benefit history. And I should say, you could treat the results in this paper for these male high tenured workers as a proof of concept. But I tell you that, most, if not all of these results are quite stable to relaxing these restrictions. And with that, I'm going to dive you right in. This is a figure that many of you are familiar with that show you the earnings losses relative to earnings 8 to 10 years before job loss around the job loss event, which is that vertical line. And I always show you figures for 4 age groups at job displacement, right? From age 20 to 30 to age 50 to 55. And this is a familiar figure because for all but the youngest group, earnings don't change in the treatment and control group. So this is the difference in earnings of job losers relative to earnings of similar workers that did not lose their job. And around the time of a job loss, job losers receive a sharp loss in earnings, some recovery, and then earnings losses that are lasting 20 or more years. And these losses are substantially larger for workers who are in middle age or in their early 50s. I'm showing you the earnings figure just as a benchmark. Today, I'm actually going to concentrate on employment. So I'm going to move showing just the same figure for employment with it, of course, the detail that since I restricted earnings to be positive, right, I can only show you the employment figure after the job loss. So these show you now the losses in employment after a job loss relative to a control group of non-displaced workers among job losers by age group. And you see what other people have found is that, in the short run, everybody experienced an employment loss. And those employment losses are just substantially larger for those who are in their early 50s. And note that this is a figure from my prior work. I purposefully excluded workers who are above 56 from this figure to avoid labor supply choices on an extensive margin so that they can better interpret the earnings effects, right? Now, for this paper today, I do want to exactly look at labor supply choices after age 55. And so I include them and I show you the same figures of difference in employment losses after a job loss over the very long run, including those ages up to 70. And you see that that figure changes substantially, especially for those who were displaced in their early 50s, but also those who were displaced in their 40s and 50s. They, after 10 years or so, have started to substantially catch up their employment effects relative to a control group. And what's happening here is that workers in the short run experiences these long-term earnings losses, but in the long run, they work longer than the control group. So I don't show you this, but the control group retires faster, right? Versus those who are displaced stay in the labor market longer. And so that gap is shrinking. And in fact, eventually there's a complete catch up when essentially the control group has almost entirely retired, right? And now I'm going to show you that directly by looking at benefit claiming as well, right? So here we have that first result that there's the short run large negative effect, but that the long-term effect is substantially smaller because workers, if you give them more time, they tend to retire later than the control group. So here I show you the average age of benefit claiming, the difference in benefit claiming among job losers and those who do not lose their job. And what you see here are the years since job displacement. Now in the US, you can only claim you can start claiming at age 62, and most people claim, between 62 and 65, right? So to the left of this figure are those people who are displaced really close to the ability to claim benefits. And in fact, you see that when the job loss occurs near the age in which you can claim benefits, people claim earlier, and there's a substantial decline in the average age of benefit claiming. But if you were displaced at age 50, say, right, or let's say at age 45, or even age 40, right, you have many, many years to go until you can claim benefits. And hence the effect turns positive, meaning these are cohorts that then claim their pensions later, right? And that's the same result, just looking as we saw in the labor supply case, that workers have a longer working lives if they were displaced in middle age. Now, you would hope, right, that this gives them some ability to recoup their losses in their pension benefits that the earnings losses would imply. And the answer is, well, unfortunately not. And that's what I'm going to turn to next. I'm going to show you again, right, the effect of a job loss relatively close to retirement age or relatively far away from retirement age, but now on the amount of pension benefits that these workers receive. In the short run, if you are displaced close to retirement age, we saw that these workers claim substantially earlier and they take a big hit in their pensions, right? If they have a few more years to work, right, it looks like they can make up some of that loss by replacing some of the zeros in their earnings history. But over the longer run, the longer you have been, you work at this low earnings level, right? The ability to work longer and to replace some zero earnings years or low earnings years, right, is outweighed by the fact that your entire lifetime earnings are just lower because of these large earnings losses. And so the further away from retirement you are displaced, the bigger is your loss in pension benefits. And so I'm gonna be close to wrapping up, right? What we looked at the effect of a job loss on labor supply and pension claiming and pension amounts. And we cared about the short run effect, but in particular, we were curious about the very long-term effects. And to study the long-term effects, we had to go back to a past recession, and we picked job loss during a particularly large recessions in the United States. And we have three findings, right? We find, as others have found, a very large negative labor supply effect and a strong rise in early benefit claimants if workers are displaced at old age. But if they're displaced in middle age, we have the opposite effect. They tend to work longer and claim public pension benefits later. And then the bottom line for their pension amounts is that delay in claiming helps some workers who were not immediately retiring but had a few more years to go, but it doesn't really help those workers who are really affected by the long-term reduction in earnings that depresses their pension benefits. And then, of course, in economic terms, you can interpret the short-term effects as a substitution effect. Workers have lower labor market options and retire, right? But the long-term effect, you would think about a wealth effect. And I didn't have time to talk about it. All of these effects are, reasonable, but quite substantial. So looking ahead, for the cohorts affected by the COVID-19 crisis, I would ask myself and look for, intermediate, medium-term, long-term earnings losses. And if we see for those in middle age, these larger earnings losses, I would definitely project that there would be shifts in labor supply and strong effects on pensions down the line. I'm going to finish here and thank you for your attention.